money, or currency rather, and consequently they don't want to upset their bankers. So they're not in the business of running around and telling everybody how awful the American government is and how they're destroying their currency and all the rest of it, and we're going to sell it off. No, they would rather keep quiet at things. Now, a very good example of this is India. India does a huge amount of trade with the West, and it's not in its interest to rock the boat on currencies at all. And it's only recently, actually, that India has sort of decided to start protecting herself by accumulating gold reserves. And, they haven't finished doing that. I mean, it's quite clear to me that they need to get their reserve position up even further.
Now we'll show you the best clips of the latest interview, but first hit the like button, smash the subscribe button. Join our WhatsApp channel for real-time updates, breaking news, and expert predictions on gold, silver, and financial markets. Link in the description or pinned comment. Stay ahead of the curve. Don't miss out.
On the one hand, you got the revenue diminishing. You got that debt to GDP ratio. This is, this works out of the GDP actually contracting, if you look at it, taking that distortion of extra government inflation pushed into the GDP. Consequently, the idea that there is the backing for central banks is just not true. The ultimate backing isn't there. And we have to tie this in with the credit bubble. Most people don't really understand they're in a credit bubble, but you've only got to look at the other side of credit. Look at debt. Oh, yes, we're in a debt bubble. We all know that. So if we're in a debt bubble, we are in a credit bubble. And that credit bubble is the biggest ever seen in the history of the world. So that is now beginning to topple over. And we see this with stock markets in particular. We see it with cryptos like Bitcoin. We've also got, which is very alarming, I think, a combination of events which we saw in 1929 to 1932. That is to say, the unwinding of the credit bubble of the Roaring Twenties, which was brought about by Benjamin Strong at the Fed, who was a monetary expansionist. And at the same time, you had the Smoot-Hawley Tariff Act coming in, which increased tariffs by an average of 20%. And some saying, there were cases where it was more than that. And what happened? You had other nations, I think something like 67 trading nations at that time responded by increasing their tariffs against the US. So you had this tit-for-tat thing, which suddenly, along with the credit bubble bursting, just threw the whole world into a depression, and particularly America, where some 9,000 banks went bust. This time round, of course, we can't allow banks to go bust. And, they're not small two-branch banks, which, was sort of typical in America in the late 1920s and into the 30s. But, the Fed's going to have a problem. How can it rescue? How can it underwrite the commercial banking system if it is deeply in negative equity and it is becoming apparent to foreign holders of the dollars that they're not getting compensation for the risk of holding those dollars, so they are selling dollars for gold, which is actually what we see at the moment. As far as the Fed is concerned, the only result, if you like, of their trying to rescue the entire financial system in America will be to drive the dollar down. Because part of that is going to be suppression of interest rates, which will be rising. So, this is a situation which I think people are not really aware of. I mean, for a start, they're not really aware. They may just be becoming aware, if you like, that there's a credit bubble bursting. But the vast majority of investors aren't there yet. And I think the second thing is that this sort of comforting thought that, the central banks can always print their way out of trouble, and, negative equity doesn't matter in a case of a central bank, and anyway, the government's going to rescue them or whatever, you backstop the whole thing. This, I'm afraid, is not the case. It cannot happen. So we need to understand this. And I think the earlier we understand this, the better for us.
In today's news recap, silver price forecast. Silver sees upside above $33.40 on soft U.S. PPI and CPI, Trump tariff fears. Silver price trades close to near the monthly high of $33.40 in North American trading hours on Thursday. The white metal strengthens as cooling United States consumer and producer inflationary pressures pave the way for the Federal Reserve, Fed, to cut interest rates. In the June policy meeting, the U.S. Producer Price Index report showed that the headline and core producer inflation decelerated at a faster than expected pace to 3.2% and 3.4% respectively in 12 months to February. Month-on-month headline PPI remained flat while the core figure deflated by 0.1%. On Wednesday, the U.S. headline and core consumer price index rose by 2.8% and 3.1% respectively in February, slower than their estimates and their prior releases. Last week, Fed Chair Jerome Powell stated that the restrictive monetary policy stance won't long last if the labor market unexpectedly weakens or inflation falls more than expected. The scenario of lower interest rates by the Fed bodes well for non-yielding assets such as silver. On the global front, escalating economic risks due to U.S. President Donald Trump's tariff agenda have also improved the safe haven demand of the silver price. On Wednesday, Trump confirmed that he will respond to counter tariffs from the European Union. Such a scenario would result in the EU-US trade war, which will diminish the risk appetite of investors significantly. The cautious market sentiment has also increased the safe haven demand of the U.S. dollar, but U.S. economic risks and soft CPI report have capped its upside. The U.S. dollar index, which tracks the greenback's value against 6 major currencies, rises to near 103.80 from it.
What you say is absolutely right. But I think there is an additional point, and that is that foreign ownership of U.S. financial assets is now more concentrated on equities than on U.S. treasuries. At the last count, we were looking at something like 15 trillion of portfolio holdings in equities. And, as the equity markets turn south, they're going to start liquidating that. So you can see that there's an avalanche, a potential avalanche of selling going to develop there. It's a combination of feeling that this is the case and also understanding the real background to it. Drives me to the conclusion that this is something that could actually happen very, very quickly. All we know is that overseas investors were caught up in the crash, but I think Winston Churchill lost money in that crash, believe it or not. John Maynard Keynes lost money in that crash as well as other economists like Fisher, who at the time stated that he thought that that equities were at a new high plateau, or words to that effect. But I don't think it's not like today, because the difference between then and now is that instead of gold acting as the international reserve money, we've got the dollar acting as the international reserve currency. And so foreign exposure to the dollar is far, far larger than it ever was in previous times. And on top of that, American brokers have been very, very successful in promoting U.S. stocks around Europe, around the rest of the world, so that they're very much owned, if you like. The typical foreign investment, let's say for a European investment manager, the heaviest weighting is always in U.S. equities. So, and you've got the comfort, if you like, as a manager, knowing that the dollar, if you like, is, you don't have effectively currency risk, in the sense that you're investing in an asset which is denominated in the reserve currency, if you see what I mean. It's very, very different for an investment manager in Europe, say, investing in the Japanese stock market, where the Japanese yen, whatever its merits may or may not be, is not the reserve currency. So it's built up in huge, huge quantities. And of course, when you get a bull market, everybody just increases their positions because, it's as easy as anything to make money, and it's going up, so you've got to buy it. And the foreigners have been sucked in just the same as US nationals have. But it is a credit bubble. And as I say, the best way to get a grasp of how serious it is look at the debt bubble. And if you've now got a global economy that's contracting, partly because the credit bubble is too long in the tooth to support the underlying economies, and partly because of new U.S. tariff policies, you can see that the financial destruction could be absolutely enormous, and it's inevitable. And the question then becomes, how far does it go down? Partly. And what the hell's the Fed going to do about it? The Fed, I think, has a clear mandate under these circumstances to try and support markets in an effort to support the economy. And that means, as far as the Fed is concerned, that they've got to cut interest rates. But the exchange rate will demand a rise in interest rates. So, I mean, they can make the Fed funds rate zero, but, they do that. The yield, let's say, on a 30-year treasury could be 15-20% quite easily. A very steep positive yield curve. Why? Because of the risk.